Hello everyone, this is Alex Suslov, Head of Capital Markets at A&D Mortgage with our AD Weekly Digest. As always, we're here to shed more light on economic events, mortgages and market forecasts. Retail sales fell by 1.1% in December, reflecting inflation's impact on consumers during the holiday season. Industrial production also fell 0.7% last month due to fewer orders and weaker demand. Hawkish comments from the Fed continued to lower sentiment as officials repeated calls for more rate hikes despite acknowledging an overall slowing trend in the inflation. In addition to Fed policy, investors will continue to assess the strengths of corporate earnings against the backdrop of the higher rates. Beginning of this year, we see mortgage spreads tightening both on conventional and non-QM, which should relate in a pricing improvement in the coming weeks. Once again, I want to remind brokers we have flow-down options for loans locked at higher rates. Please refer to our lock policy on the AD website and reach out to Lock Desk for lock changes. At this moment, turning this to Billy to get more insight on the recent economic numbers and what indicators to watch ahead of the next FOMC meeting. Hello Billy, how's it going?
Hello Alex, all's good with me. It was a quiet week on the economic calendar, but a few of the reports stuck out to me. There was a retail sales report, which you mentioned. It came in lower than expected, and it came in with a downward revision to last month's report. And while not as important as CPI, there was a PPI report, which also came in better than expected, and also with downward revisions to last month's report. Then there was the Empire State Manufacturing Index, expected to be minus 8.7, but it came in at minus 32.9, which is the worst number it's shown since May of 2020. That one is a read on manufacturing activity in the state of New York. But with a miss like that, you don't really know what it means to know how soft it was and what a surprise it was. All those reports reflect a weakening in the economy, and they're market friendly. The only meaningful market unfriendly news came from the weekly jobs report, the weekly jobless claims, which were expected to be 214,000, and yet they came in at just 190,000. That was the lowest number they've reported since August. So by and large, we learned that the economy may be slowing down, and we learned that inflation seems to be as well, but the labor markets remain very strong. Treasuries have basically rallied since the first day of this year. They continued to do so until both the 5 and the 10-year had traded through their December yield troughs, which was the clearest and most obvious resistance on the charts. I had suggested that if the Treasuries could trade through those December yield troughs, that would be my first indication that last October's yield crest could hold throughout this year. I still think that's possible, but at the same time, since well before the October yield crests were ever printed, I was expecting to see corrective recoveries lasting 3 to 5 months. And then following that, new high yields that would complete the moves. We're now more than 3 months into these rallies, and that leaves me a little bit conflicted. I think what's going to happen, the Treasuries are overbought by almost any measure, and I expect we'll see pullbacks coming pretty soon, regardless of where we are in the bigger picture. And how those pullbacks unfold is what I hope will tell me where we are in the bigger picture. Thursday we get advanced GDP, but Friday's the day that can produce fireworks since we get the core PCE price index, the Fed's preferred measure of inflation, and the one thing that I think could still impact what they do on February 1st. It seems likely they're going to raise the Fed funds 25 basis points, but the PCE is ugly. I think 50 is not out of the question. In either case, I think we're close to a pause. I suspect with Fed funds at 5%, maybe 5.25%, there'll be a hold. And I think dependent on inflation and jobs numbers between now and March 22nd, that will be the determining factor. March 22nd being the next FOMC meeting. Now with that said, I'll kick it back to you, Alex, and I look forward to tomorrow's webinar.
Billy, I appreciate the overview. Next week will mean a lot for understanding Fed policy in 2023. We're all looking forward to it. Be sure to join Billy, me, our CEO Max Liserchuk, and Rob Chrisman tomorrow on January 21st at 1 p.m. for our upcoming webinar, which is called Experts Roundtable, Where is Non-QM Headed in 2023? Be prepared with your questions. We will make sure to answer as many as we can. That's it for now. Make sure you follow us on YouTube channel, like this video and subscribe to Billy's daily market newsletters to stay on top of the capital markets events. Thanks everyone, it was Alex Suslov, Head of Capital Markets at A&D Mortgage. Stay tuned.